Did you know that when the Federal Reserve increased the interest rates from 0.25% to 5% in 2023, it had negative effects on the economy? Did you know it even increased the probability of a recession? Hello and welcome to Fun Financial Insights, the channel where we explore the fascinating world of money and economics. And today we're talking about a very controversial topic, Warren Buffett's opinion on a possible 2024 economic collapse. Yes, you heard me right. This is not just a clickbait title. According to the legendary investor and CEO of Berkshire Hathaway, the U.S. economy is heading for a major crash in the next few years, due to a combination of factors such as high inflation, low growth, and rising debt. And in this episode, we'll look at the evidence, the implications, and the strategies you can use to protect yourself and your assets from the potential disaster. So first off, who is Warren Buffett and why should we care about his predictions? Well, Warren Buffett is one of the most successful and respected investors of all time. With a net worth of over $100 billion, Buffett has a track record of making accurate predictions about the future of the economy and the markets. For example, he warned about the dangers of the dot-com bubble in the late 1990s and the subprime mortgage crisis in the mid-2000s, and avoiding investing in those sectors. He also predicted the recovery of the U.S. economy after the 2008 financial crisis and invested heavily in stocks when they were cheap. Although Buffett is not always right, and he admits that he makes mistakes and changes his mind. For example, he was initially skeptical about investing in technology companies, but later bought shares of Apple and Amazon. He also sold some of his airline stocks at a loss during the pandemic, but later regretted it as they rebounded. So what is Buffett's prediction for the 2024 economy, and what are the reasons behind it? Well, according to Buffett, the U.S. economy is facing a nightmare scenario where it will experience high inflation, low growth, and rising debt. Here are some of the main factors that could trigger this scenario. First off, inflation. The U.S. economy is experiencing a surge in inflation, which is the general increase in the prices of goods and services. The annual inflation rate reached 6.8% in November 2023, the highest level since 1982. And inflation erodes the purchasing power of money and reduces the real returns on investments. Inflation is caused by a variety of factors, such as the expansion of money supply, the increase in demand, and the decrease in supply, and the rise in expectations. The next factor is growth. The U.S. economy is experiencing a slowdown in growth, which is the increase in the production and consumption of goods and services. The annual growth rate at the gross domestic product, GDP, fell to 2.1% in the third quarter of 2023, down from 6.7% in the second quarter and 6.3% in the first quarter. Growth is affected by a variety of factors, such as the level of investment, the level of consumption, and the level of trade and the level of innovation. Hey, before we go on, if you're enjoying this video and finding it helpful, please be sure to hit that subscribe button to get more fun financial insights every week. Now let's continue. And thirdly is debt. The U.S. economy is facing a high level of debt, which is the amount of money that is owed by the government, the corporations, and the households. The total debt of the U.S. economy reached $85.9 trillion in the third quarter of 2023, up from $74.4 trillion in the fourth quarter of 2019. Of course, not all debt is created equal. It can be beneficial if it is used to finance productive activities, but it can also be harmful if it is exceeding the ability to repay or if it leads to financial instability. Some of the risks of debt in the U.S. economy include the rising interest rates, the increasing budget deficits, the growing corporate leverage, and the rising consumer delinquencies. These factors, combined with the probability of a global recession in 2024, some experts predict that the U.S. economy could collapse by as much as 30% by the end of 2024. Now, how does this affect sectors like the real estate sector? Well, keep watching and I'll explain that next. The U.S. real estate sector is part of the economy that deals with the production, distribution, and consumption of land and buildings. It includes residential, commercial, and industrial properties, as well as related services such as construction, brokerage, leasing, and management. The U.S. real estate sector is one of the largest and most influential sectors in the world, accounting for about 13% of the U.S. GDP. And it is sensitive to changes in interest rates, income, demand, supply, and expectations. Historically, the U.S. real estate sector has experienced several booms and busts, such as the Great Depression in the 1930s, the savings and loan crisis in the 1980s, and the subprime mortgage crisis in the 2000s. The most recent boom in U.S. real estate sector started in the aftermath of the 2008 financial crisis, where the Federal Reserve lowered interest rates to near zero and launched a massive quantitative easing program to stimulate the economy. These policies made borrowing cheaper and easier and boosted the demand for housing. At the same time, the supply of housing was constrained by low inventory, limited construction, and strict lending standards. As a result, home prices soared to record levels, reaching a median of $363,300 in June 2023. However, this boom may not last much longer, as several signs point to a looming bust in the U.S. real estate sector. Apart from the general factors we already discussed, here are some of the main factors that could trigger a collapse in the near future. First, interest rates. The Federal Reserve raising interest rates and starting to taper its bond buying program in response to rising inflations and economic growth. Higher interest rates make mortgages more expensive and less affordable and reduce the demand for housing. They also increase the cost of servicing existing debt and puts pressure on borrowers who have adjustable rate mortgages or home equity loans. Supply and demand. The supply of housing is expected to increase in the coming years as more homeowners decide to sell their properties, more builders ramp up their construction, and more foreclosures hit the market. The demand for housing is also expected to decrease in the coming years as more buyers face affordability issues, more renters opt to stay put, and more households experience financial stress. Expectations. The expectations for the future of the U.S. real estate sector are becoming more pessimistic, and more analysts, investors, and consumers anticipate a downturn. According to the Zillow Home Price Expectation Survey, the average annual home price growth forecast for 2024 dropped to 2.5% in December 2023, down from 4.2% in September of the same year. Now, this video isn't all doom and gloom. What does this really mean for you, and what can you do to prepare for the possible 2024 economic collapse generally and in the real estate sector? Here are some tips to help you navigate this challenging situation. As an investor, you need to be diversified and prudent. Don't put all your eggs in one basket or rely on one source of income. Avoid investing in speculative or illiquid assets such as cryptocurrencies, collectibles, or private equity that may be hard to sell or value. When it comes to spending, you need to be frugal and smart. Don't spend more than you earn or more than you need. Create a budget and track your spending to avoid wasting money on unnecessary or impulse purchases. If you are currently a homeowner, consider refinancing your mortgage to a lower fixed rate if you haven't done so already. This will help you lock in a lower monthly payment and reduce your exposure to interest rate risk. Buying a home in this period may seem a little difficult, but if you want to, don't buy a home that you can't afford or that doesn't meet your needs. Don't assume that the home prices will always be going up or that you can always sell your home for a profit. Do your research and compare different properties, locations, and financing options. And if you are thinking about buying a home, don't let the fear of missing out cloud your judgment. Renting may be a better option for you, especially if you value mobility, convenience, and stability. When renting, look for rentals that offer incentives, such as free utilities, parking, or amenities. Negotiate for lower rent or ask for a rent freeze or reduction. Remember, knowledge is power, and being informed is the first step towards securing your financial future. If you found this video helpful, don't forget to give it a thumbs up and drop a comment below. We'd love to hear your thoughts on the 2024 economic outlook and any strategies you're considering. For more insightful content on navigating the complex world of finance, subscribe to Fun Financial Insights and hit that notification bell so you never miss an update. And as always, thank you for joining us today. And remember, even in challenging times, there are opportunities for those who are prepared.